Welcome back. The Bank Nifty is the fastest rising index today. And that's after the Reserve Bank announced a bunch of measures that is designed to remove the liquidity deficit that the markets are reeling under. Hopefully, that will reduce the competition for deposits, which is impacting banks. Of course, we've also had a bunch of banking results. Practically all the private sector banks have announced the numbers, and public sector banks are also coming in thick and fast, barring, of course, a big boy SBI. So to discuss both the results and the impact of this newly announced liquidity measures, I have two experts joining me. Pranav Gundlapalle, the senior analyst at of financial sector at Bernstein, and Santanu Chakrabarti, the India BFSI analyst at BNP Paribas. Santanu, Pranav, good morning, and thank you very much indeed for joining us. First, why don't you all start by telling me what you have made of the liquidity measures in terms of the impact on banks? Santanu.
Thank you, Latha, and a very good morning to both you and Pranav. One of the issues that we have been flagging for the last 2 months, and especially in December, it took on really alarming proportions, was the lack of liquidity within the system. And the weak deposit numbers that you have seen for a bunch of banks in the quarter is a direct outcome of that tight liquidity, and it has slowed down both deposit as well as credit growth. Now, this liquidity shortfall was primarily because of the dollar sales that the RBI has been doing, and right now this 60,000 crore is absolutely a stitch in time as far as we are concerned, because it may not have an immediate impact on the amount of credit hunger that banks may have right off the bat. But it is a step in the right direction and probably also signals a policy pivot as far as the RBI is concerned. We know that 3 months back they went from withdrawal of accommodation to neutral. This in effect becomes for the first time accommodation of growth, even if not in jury basis, definitely on the de facto basis.
Okay,
that's
from
what
neutral
this
to accommodative, possibly
Yes.
signaling a cut. But Pranav, if the cut were to come, and first of all, are you pricing in a cut? Given that they have given liquidity first, usually you have to ease liquidity before you give the cut. And if a cut comes, would it be all bank positive? Wouldn't it be also a bit negative on margins?
Morning. So I think we are pricing in rate cut. We think we have factored in about 50 basis points of rate cut in the first half of the year. And yes, it will be immediate impact will be negative on the banks because they will start to lose their NIMs. So the NIMs will see a drop, and therefore the immediate impact is negative. But I think it's a positive on the growth. I think the very act of easing liquidity like they did yesterday, as well as a rate cut, would support growth, both in terms of credit growth for the banks as well as the overall consumption growth. And that would be the longer term positive. And for the banking sector, I think a reduction in NIM and therefore a bottoming out of profitability will in a way serve as a catalyst, because I think the reduction in ROA was something that's been long expected from the unsustainably high levels. So I think once that happens, it'll be a clearer path towards earnings growth from there. And that should again drive some interest back into the sector.
Okay. I'll come back at the end of the conversation to ask you whether this move is changing your assumptions, any of the assumptions of banks. But first, let's discuss the results itself. Santanu, what did you make of, let's take the top two banks, ICICI and HDFC Bank. Has it led you to increase EPS or target prices on both of them, or any question marks?
So, as you know, Latha, I have fairly generous target prices on both of these names,
yes.
Especially on HDFC Bank.
HDFC.
So look, the pattern that I would like to draw attention to, that, the kind of tight liquidity that we saw in the last quarter absolutely separates the wheat from the chaff as far as the, the liability franchise quality is concerned. So you would notice that even in the, ICICI numbers are absolutely stunning as far as the deposit mobilization is concerned. And ICICI and HDFC both stood out in terms of the amount of deposits they have been able to mobilize. What ICICI has done in current accounts, a 98,000 crore number for HDFC on term deposits, despite the liquidity being where it is without moving rates, it just shows you that, in tough times, the ability of the more established liability franchises, especially where large rate differentials are not present between the various banks, completely shines through. And I think this market share gain pattern will continue as liquidity eases. And if liquidity eases, rate cuts come through, and uh, we see a gradual acceleration in CASA as well, and not just credit, then these two banks would be, well positioned to uh, benefit from that. And of course, given the space, the point that HDFC Bank is coming from, the relative influence on HDFC Bank's earnings of such an acceleration is higher. While ICICI was able to maintain CASA at 40.5%. So on a relative basis, it will be more significant for HDFC Bank. But both of them have completely hit it out of the park in such tight conditions.
Oh, absolutely. I mean, HDFC Bank, what is the size of the balance sheet? To be able to grow 16% deposits on a 25 lakh crore balance sheet is certainly steaming growth. Pranav, I don't know if you cover the other banks. I was among the ratios and percentages, Kotak Bank definitely stood out, especially because in Q2 there were some worries about stress. As well, any of the others, IDFC, IndusInd, any of the other banks that you want to speak about, what stood out for you?
See, I think overall, if you look at across the board, I think the key concerns going into the quarter was that if the asset quality stress that we saw in pockets of consumer lending and MFI will spread into the other segments and also into the other banks, I think that fear didn't come true. We largely saw a repeat of last quarter in terms of lenders or segments that saw trouble. So I think that was the big positive into the sector, into the quarter. And in terms of the Kotak specifically, I think the growth was the big positive. I think especially coming after an Axis which disappointed on growth, coming in at 9% growth, I think a 15% growth despite the RBI restrictions, I think was the big positive without a severe impact on margins. Right? So it was always a growth margin trade-off that Kotak was facing. But I think the reduction in the savings account rates and a few other factors did help it limit the profitability hit. I think that was a big positive. And that's probably the reason why we saw the sharpest move for Kotak post results. Whereas for most of them, I think it's pretty much a continuation of what we saw last quarter. And hence not that big a move as to what we saw for Kotak.
Yeah, no, Kotak had many positives. Even their slippage ratio, we were worrying about, that fell from 1.9 or 1.88 to 1.6. As well, margins actually quarter on quarter have risen by 2 basis points, even if it's a fall year on year. I take a point on that. But do you track any of the other? I mean, we had a bunch of public sector banks coming out with numbers. As well, Federal has come out, and today it's getting a pasting in spite of the manna from RBI. Any of the other banks that you cover where you have a point in terms of downgrade or upgrade, Pranav?
Nothing as of now. I mean, we would go back and review the numbers in the context of the sector results, but no change in ratings as of now.
Okay. Shantanu, a similar question to you. Any of the other stocks under your coverage where you have a point or two, and you also have Kotak for coverage. I don't think you had a buy when we last spoke.
No, I have had an underperform for the long time. Now, obviously, our ratings are on a relative basis. So I do have absolute upside on Kotak, but it remains an underperform. See, while I notice the high growth and all of that, the trouble with fixing Kotak's capital productivity situation, which will lead to a full re-rating. The ask of growth is very high. Now, maybe with easier liquidity, that gets helped. As far as the other names are concerned, Latha, I think I would draw your attention to, even something like a FedFina, which has made a big provisioning for incumbent stress that they might see in something like small ticket LAP. So while, the stress has remained mostly contained as far as large bank is concerned in things like unsecured and MFI only, and two very disparate lines of stress, let me be very clear. Yeah. I think at least within the smaller NBFC, some of the smaller bank categories, they seem to be bracing up for some degree of contagion within perhaps that customer group which is one notch below premium. And that, I mean, given that how fungible credit products have become, a fungibility which was earlier available only with, bank customers, prime bank customers, so to speak, probably for the first time, there might be a little product agnostic minor contagion happening within those customer segments as well. And it's something we will keep an eye out for.
Okay, no, fair point. But just a word, Pranav, is there any other NBFC that stood out for you? I mean, Sriram's numbers looked very good, but you run through them. Chola, anything that stood out for you?
Nothing that really stood out. I mean, I think it was more a relief on, at least for the larger NBFCs. We get to see Bajaj on Wednesday. But for most of the others, I think it was largely a relief for the larger ones. That there is no big blowout in terms of credit quality.
Of credit quality, yeah, absolutely. The unsecured, we did hear Federal tell us just a little while back, I mean, sorry, not NBFCs, but the bank did say that the contingency, the provisions that they have kept are for a fear that in case the unsecured portfolio deteriorates. So clearly that fear is still there. But Shantanu, to come back to the topic at hand, the Reserve Bank's liquidity largesse. Now, how do you see the trajectory of the big banks? Private sector banks will still have a bit of a dip in NIMs when the rate cut comes, and it now looks more imminent on Feb 7. And then they grow. So what is the trajectory you would draw for these banks? They fall and then they rise?
I mean, Pranav also indicated the same thing in his narrative when he spoke, that rate cuts obviously bottom out margins. But to take a view of rate cuts being a negative for bank margins or earnings growth will be a little myopic, frankly. Right? I mean, from that once that bottom is marked, right, maybe 1.5 quarters after the rate cuts, from that point onwards, you're going to get acceleration in credit, hopefully. You're going to get better liquidity should drive a revival in current account. If the rate gap narrows, that should help you with savings accounts. And you basically start on a benign margin expansion trend, probably for the larger banks. It is nothing too dramatic. But there's no credit cost expansion or operating cost expansion to space spoil sport. Which means what? That if you get decent credit growth, and for the larger private banks, it is hard to argue credit growth below mid-teens, right?
Yes.
So then your earnings growth becomes above mid-teens. And when you look at valuations currently in either PE terms or in terms of ROEs that are likely over the next 1 year and the price to book they're trading at, that's what makes us fairly bullish about the prospects of these banks.
Okay. Well, final words from you, Pranav. What is your sequence of buying? And would you change anything because of the expected rate cuts?
Okay, firstly on the rate cuts, we wouldn't change anything in terms of our sequencing because we still think the asset quality trends will probably be more important in the next few quarters versus a 50 bips of rate cuts, which we think will be much lower impact compared to the asset quality trends. In terms of our picking order, we like HDFC the most, followed by IndusInd as a near-term re-rating story that we see. And then you have ICICI and Axis, followed by SBI and Kotak. So that's our pecking order in terms of the large banks. Okay. In terms of the NBFCs, we're still on the sidelines with the pure consumer lenders like an SBI Cards or Bajaj. We think we would wait for a while longer before trying to bottom fish on the consumer lenders at this stage.
Okay. Oh, that's as comprehensive a wrap as we can get, Pranav. Thank you very much. Shantanu, thank you very much for your contribution as well. Quite clearly, both our experts think that big is beautiful. All the big banks are in their buy list. Wrap up on Bazaar on that note. Chartbusters coming.